Better than expected December CPI print. My next guest says this morning's report could be a good sign for the months to come. Joining me now with his market outlook and his best stock ideas for this month is Fundstrat Global Advisors Tom Lee, a CNBC contributor. Welcome back.
Great to see you, Scott.
All right. First, your view right now on this market is what?
I think that markets are showing some relief that CPI was dovish, and actually I think some of the inflation prints the last 2 days have been dovish, including PPI. So it's setting the stage for yields which kind of were close to touching 5% to kind of cool. And at a time when sentiment's been negative, I think we should be rallying.
Is the Fed back in the game? Which means this report was good enough, these two reports, really, as some are saying that, okay, you're not going to get a cut in January, but you could get one in March. And some people had written cuts off for many, many months.
Yes. Into this CPI print, the whisper number for core CPI was over 0.3. So the market was bracing for a really hot number. And you could see it in the Fed fund futures where, as of yesterday, there was a 30% plus chance of a Fed hike. I think those sort of extreme views have been quelled. And I just think generally, without counting for the fact that the California fires could mess with inflation, the inflation print over the next 3 months is going to be a lot lower than what we saw November and October. And remember, January to March of last year, it was close to 0.4. So I think inflation is setting up for some good comps.
Okay. How optimistic are you for the type of return we could do this year after back-to-back, 20+% gains for the S&P?
We've gotten some good harbingers so far because the first 5 days of this year, the S&P is positive. So I'd say there's an 80% chance of something over double digits for the year. And what's going to matter to a lot of people is how we do for the month of January. But as of January 15th, we're up 0.7%. So those are good harbingers for the year.
Can we have a good year if the Fed doesn't cut until later in the year and bond yields remain elevated for a while?
If bond yields get stuck here, it is a severe tightening of financial conditions. And I think it's going to hit housing, and we're already seeing it now. So I think it is important for yields to move directionally lower.
That's a long way of saying stocks will not be good if bond yields stay where they are now?
Yes, it's going to test the market's resolve. I don't think it kills equities, but it's hard for someone to be pounding the table if they think yields are going to be stuck at close to 5% for the next 6 months.
Wow. So if yields, let's just say they stay near where they are now, you wouldn't be as optimistic as you are?
I think it's going to raise concerns there's a policy error from the Fed, that either financial conditions are too tight or the bears will argue the Fed made a mistake cutting too aggressively last year.
But isn't this the base case? I mean, you have what is arguably a more inflationary environment because of some of the policies that are being talked about by a new administration. Sure, they may stimulate more economic growth, but with that potentially comes more sticky inflation too.
Well, there isn't necessarily a connection between growing faster and more inflation. There is some inflation that can be generated by tariffs, and that's the uncertainty.
But that's what I mean also. It's like tariffs, it's inflating the deficit. It's just reinflation. It's the reinflation trade based on some of the expected policies that may cause that.
True, but to keep in mind, last year's inflation, first of all, a lot of last year's inflation was what they call imputed because it was just statistically catching up to the price changes of the years before, but it's housing and auto insurance were 80% of the inflation over the last 4 years. And the third is labor markets, which we know aren't in an inflationary position. So in order for new policies to generate inflation, they have to be powerful forces that fiscal spending hasn't generated the last 3 years. So I'd say that it's difficult for me to make the case inflation's getting strong.
Okay.